Welcome back, folks. Welcome to a new week of trading. Before we get into it, just let you know it's going to be a short session today. I'm going to try to keep the sessions brief because the teachings are going to be pretty lengthy. So just keep that in mind. I know some of you have an issue with timeliness about digesting the content, but I'm going to keep the majority of the focus in the teaching, so there'll be long-winded sessions there. I want to introduce a concept you're going to be referring to in Lesson 3. We're going to be looking at relative strength analysis today and some ideas when you use these concepts and where to apply them. So it's kind of like a complementary teaching because I'm just going to briefly mention it in passing in Lesson 3, so that way I'm not bogging down that lesson because there's a lot of content for Lesson 3. So if I give you supporting teachings throughout this week, they will be in concert with the same idea or premise with Lesson 3, because otherwise I could create a whole month of just Lesson 3 by itself. I guess in a way it really is, but it's sub lessons or supporting lessons to drive home the content. Okay, so we're going to be looking at the weekly charts first, and we're going to just scroll through the euro, the pound, Aussie, New Zealand, CAD, Japanese yen, Swiss C, and the dollar index. Now, I'm not showing any charts with analysis on it. All we're looking at is price action, okay? And we're going to be looking at some specific viewpoints and things that are salient to knowing what the future price legs may be, higher or lower, or if there's going to be a high probability for a swing at all. Now, obviously, if we were all in the room together and I asked you all to raise your hand, and I'm asking this rhetorically, so those that are here live, you don't need to do this. The folks that look at analysis and they start looking at trend lines, or they look at the Elliott wave or market structure even, some of the things that go along with all of those ideas are generally kind of the same. You're looking for something to indicate that the market's going to move higher or lower. What I have learned is that very few teachers or disciplines of trading focus on the conditions of the marketplace that would arrive at a probable trade for swing. If the markets are predisposed to go higher or lower, that's one thing, okay? But we have to look at a market that's predisposed to move in general, because most markets are generally trying to be maintained in a range, okay? And if we start on a higher time frame weekly chart, and it can be done on a monthly, I'm just going to save some time, but everything you do here on the weekly, you just apply it to the monthly as well, and we'll have those rules in Lesson 3 that you're going to have this month. But when we scroll through the weekly charts, this is the euro versus the dollar weekly, and what you want to be looking for is the last 3 to 6 months trend, okay? Or just basically what's the price action in the last 3 to 6 months. That's all that's necessary. You're a swing trader, that's your time horizon. You don't look at 15-year charts, you don't look at 20-year charts, you don't look at 1-year charts. All you need to know is what's the last 3 to 6 months time horizon. What has the market done in the last 3 to 6 months? Okay, as long as your charts show that much data, okay, you'll know where the next probable price swing is going to be and what it's going to be reaching for. And it's really just that simple. What happens is we start applying wave A, B, and C, and retracement, this and that and the other thing, and we start complicating it when it's a simple task of looking at where have we been in the last 3 to 6 months, and where are the liquidity pools, where's the PDAs in reference to the weekly chart. And here's the main thing. This is what we're focusing on today. What market profile are we in for the weekly chart and or the monthly chart? And some of you sent me questions, how do you determine what the market profile is? Like what stages of analysis or what classifications do you use to outline that or frame it as a consolidation, trending, or reversal? And we're going to kind of cover that today. So looking at the euro dollar, we're going to take a look at the last 3 to 6 months. Okay, and we're in February now, so So we're going to go back to here. We'll go back that far. And I'm going to ask you, it should be obvious, if one were to ask everyone in the room, if I was standing in front of y'all in a big group, I'd say, okay, raise your hand right now if you think in the shaded area that is a trending market. You'd all raise your hand if you believe that. And for those that were holding your hand up, I would ask you if it was trending higher or lower. And obviously we would reduce that down to a smaller group. I would ask you all, by a showing of your hand, would this be considered a reversal market profile? And you'd all raise your hand if that's what you agreed. And finally, the last one, I would ask everyone if this would be a consolidation or a range bound. And obviously, I would expect everyone's hand to be up on this one. And that would be the allocation for the market profile. I would say this is in. So with the weekly dollar being in this range, what makes it a range? The fact that it has not significantly moved away from any historical lows in recent time. This is outside of the scope of reference, 3 to 6 months. But I want you to look at this low here. Because even though it's just outside that, we had this low here, which is comparable to that. So it's not that much of a difference in terms of the range. It's maintained this range longer than 3 to 6 months. We went below it here, but has yet to show any willingness to continue going lower. That's the reason why every time we trade into an old high or an old low, you do not know with a great deal of certainty if that break below an old low or break above an old high is going to be a valid breakout. That's why we do not look at consolidations with breakout ideas. Okay, when I first started trading, the concept was look for consolidations and then wait for a breakout and then trade in that direction. I tried that and many times lost a lot of money and frustrated. So what I learned when I saw that turtle soup pattern in Street Smart's book, I fell in love with it because that made perfect sense to me. There's more false breakouts than there are valid breakouts. So if we see consolidations on a weekly and or monthly chart, we have to wait for a valid displacement from that range. For instance, if we had broken this low and this low with a lot more movement lower than what we've seen here, because we don't see much of a movement lower in this move. We only went down just a little bit below it, and I'm going to put a horizontal line so you can see the difference between that. And we're going to take a huge step forward once we outline this, and you'll know exactly what markets you should be looking for. So here's the old low in the last 3 to 6 months. So we have this low here. It went below this low and then quickly returned back inside the range. That's not good. That's not a valid breakout. That's maintaining a trading range or consolidation. So if we know that the market is in a consolidation, the first thing we want to do is try not to be looking for swing trades, okay? That would be a sell below this low. That's not what we're looking for. Okay, it has to show a significant displacement. When we look at the yen, you'll see what I mean by that. But in contrast, just know that this is a consolidation because it's having a difficult time making higher highs and lower lows. When it takes out an old low, it returns inside of the range. That's a consolidation. If it takes out an old high and trades back down into the range, that's a consolidation. It's just that simple. Now, when it's trending, it continuously makes higher highs and higher lows for an uptrend and lower lows and lower highs for downtrends. You're going to be looking at, like I said in the first teaching, referencing the professional accumulation and distribution patterns, the banking perspective. Every down candle should be supporting price, or new buying should come in, or every up candle should be seen with selling or lower prices. It should be resistance for up candles and support for down candles. If you see that in price action, you're actually seeing the institutional order flow that's pushing price. What we're focusing on is just, are we in a market that is predisposed to trend one direction over the other? Now, if we were to ask by way of a survey, if the dollar index is bullish, every foreign currency should go down and start trending. In other words, if the dollar starts trending bullishly higher, every foreign currency should be in strong bear markets then. No, that's not true. Because some markets, they may stay in consolidation. So my question is before we start looking in this discipline of trading to look for swing trades, we have to first identify which markets or asset classes, or in this case, when we're talking about Forex, which pairs or currencies have the likelihood or the probabilities of moving in a trending environment. Also, if we can take that same analogy and just reverse it, let's say that the dollar index is held in consolidation, which I believe that's what we're seeing now. Which pair or currency is allowed to move now when that dollar is being held in consolidation? That's the other equation that you have to look at. So it's not just simply A to B equals C, okay, or dollar bullishness in a trend equals all the foreign currencies in a downtrend. That doesn't equate to that. And that's what causes this business or this asset class a great deal of difficulty. Traders come in and they think that it's naturally going to be, well, if this is this, then the outcome should be that for the other markets, and it's not always the case. That's why those that have a disagreement with me in relationships to correlation, they say correlation doesn't work. Correlation absolutely works, but you have to know how to look for it and find the evidences of it in price. So yes, there's cracks in correlation, and that's how we find the SMT diversions. That's how we know that there's professional buying or distribution. But before you go into all those things, you have to determine where the stage is. What's the stage of the marketplace? Are we predisposed to move, or are we predisposed to stay in a range? Then think about it like this. If our swing trading model is heavily slanted to directional biased trading, in other words, a direction, it has to be going higher or lower clearly. Why do we focus on that? What makes it so significant that that's what we're looking for? Because if the market's being pushed one-sided, and we can see the evidence of it on a higher time frame, we know we have large flows or big banks or institutions or large funds behind that move. That means it's going to be a lot of buying, not just a little bit of buying, or a lot of selling, not just a little bit of selling. So that big elephant in that children's pool analogy I used in the market maker discussions, that displacement is evidence that we have big money at work. And that's what we need. We need to see that in our trades. So in contrast, when we look through the weekly charts, we look for not this pattern. We're looking for the pattern of willingness to move around. Is it staying inside of a defined range like this, or is it making nice swings? You're not looking for just trends, okay? You're looking for the ability to move outside of the ranges and create new ranges. Because inside those new price swings, making lower lows or higher highs in reference to what an old range would be. For instance, if we were to broke down considerably lower than this one, like this low here, if we went much lower than this, okay, then we would expect if it came back to this level, then we could see some resistance and then maybe another price leg lower. But because it only just went down below it just by a little bit, that and then returned back to the range, no, that's not good. That's not good for swing trading. So in disciplines less than swing trading, this would be a good market for short-term trading and day trading, but for swing, you can't use the euro dollar. You have to go to another pair. So let's move over to the pound dollar weekly. Okay, and we have a pair here that has in the last 3 to 6 months. In contrast, let's take a brief look at the euro. Look at the euro. Okay, and now remember, for those that have been following along, even in August and during my free sessions, I told everyone that the euro dollar is going to probably stay in a defined trading range for a long time, and it could go for months. Look where we're at. We're February. That's 6 months. It's stayed in a trading range. It hasn't gone anywhere. It's just meandering around. That's why I have been so aggressive about the euro dollar, because the money's not in euro dollar right now. Okay, so let's go over to that pound dollar and look at the last 3 to 6 months for this pair. It's real simple. It's not like a whole lot of indicators stuff. You just take in your chart and not getting too crazy, Michael. Good grief. Okay, so my question to you is this pair on a weekly chart, is this in a consolidation? No, it's in a trending environment. Now, there are smaller consolidations like this one and the one we're in presently right now, and this one here prior to it moving, but it's a lot of motion in this pair. Lot more movement in this pair than that of what we saw in the euro dollar. Okay, so if we're going to be looking for swing trades, we're more apt to finding a swing trade in the pound versus the euro. The euro is being held in consolidation, and personally I'll just add this as a note. I think the reason why the euro is being held in consolidation is because there's a lot of issues with the European Union. There's been discussions about the Brexit, whether they're going to permit it or not. Resistance is going to be on the part of the European Union in regards to all those ideas. So, and there's other countries that are considering the same thing. They're not just limiting it to just the UK. If we're looking at a market that's trending, now here's the important thing. Yes, when a pair shows strong indications like this, it's moving, not staying in ranges, it's actually moving one direction. The first thought process is, okay, this has a willingness to keep going lower. We do not try to pick bottoms, okay? So we're going to always look for evidences to look to sell short in a pair like this because it's moving lower. It's making very strong strides lower. Every time it moves aggressively and there's a big displacement, is it on the upside or on the downside? Clearly it's on the downside. It's lower here aggressively after moving in small consolidation, big move lower after moving in small consolidation, small low consolidation, big moves lower. So all the big ranges are the black candles. The big price swings are all on the downside. So this market, or this pair particularly, is heavily distributed. It's not being aggressively bought. So we have, on a weekly chart, we have equal lows down here also. Okay, so we know there's a big, large liquidity pool resting right below there. And we know we have this level up here in terms of closing in this void. And we have a short-term high that's yet to violate. So we know we have buy stops above here. Bearish order block begins on this series of 3 candles up. So we have a liquidity pool resting above 28.30 or thereabouts. And then we have the lows down here with a sell side liquidity pool. And it doesn't require you to take trades only on the sell side. Now, the best scenario would be to look for shorts on swing trades, yes. But now think about this. If you were trading, okay, and you were trading short only on this pair, you would never see these little moves here or in here or the most recent one here, because you're focusing only primarily on the downside. And that's what you should do initially. When you grow into your understanding about what you're learning in this mentorship, you will see counter trend swing trades, and that's going to be part of the specific patterns. There's going to be a section in the bullish and the bearish pattern for this teaching. I'm going to give you 2 of them that I use that's counter trend, and the conditions that I use when I want to trade against the long-term trend like this here. What would be the rules for buying in a market like this? Okay, I'll give you those. But you want to focus primarily looking at only shorts because this is being heavily distributed. Now, if we were looking at this pair and we see, okay, this pair shows a willingness to go lower, while at the same time the euro dollar is in consolidation. I want you to think about what that means for euro pound, because we're going to talk a lot about what makes euro pound move this month. If we have the pound dollar moving lower on weekly and it's having a profile that's not maintaining a range, it's in trending environment, while the euro dollar is in consolidation, it's going to have a direct impact on how the euro pound trades. And if the euro pound is based on what we see in euro and cable or British pound, by having this outline, we'll know where the biggest price moves are in directional bias for that pair, euro pound. So that also will filter out all of your other trades, for instance, short-term trades and day trades. You'll be able to focus more heavily on one side of that market or that pair. Aussie dollar, if we were looking at this pair, last 3 to 6 months, if I were to ask you if this was a trending market, consolidation, or reversal, hopefully you would all say that this is in a consolidation. It's having a difficult time trading above this high, let alone these equal highs, where I think it really wants to go. Then we have this low down here. It's been held in consolidation. Okay, so Aussie dollar on the weekly chart also has no displacement of any significant magnitude. For instance, we've not seen any price rallies that make any move outside of this range, and we've not seen any declines to take us out of this range. So this pair is in a state of neutrality. It can't find its way yet. It's being held in consolidation. Now, I taught in the market maker concepts that the market maker itself, their business is to hold a currency in a predefined range and allow other currencies to move and allow the displacement to take place there. That will affect, and it can do this by having control over the majors, which is all dollar-based. This is the reason why I teach dollar-based currencies, not only because I get tax treatment that's favorable for me in the U.S. because I trade dollar-based pairs, but by understanding every dollar-based pair or the majors, you'll know what all these exotic pairs are doing. Even though I don't trade them, and I try not to instill the idea that you should passionately try to do it, because if you can't make money in the majors, then you don't know what you're doing. It's more consistent. It's easy to see the setups against the dollar. When you compound it, and we will teach this stuff in the mentorship, but when you compound these ideas, okay, for instance, look what we have here. We have the Aussie dollar, okay, or the Australian dollar is being kept in a range. So is euro. But look at this. We have the pound moving, not in a consolidation, but it's in a trending environment. What do you think that would mean for a pair that would couple pound and Australian dollar? What would that do? I want you to think about that. I'm expecting you to know right now if you're new or if you never considered it, but I want you to think about it. These are all homework assignments for you to go in and look at what price has done relative to these ideas. For the Aussie dollar, this is another pair that is not favorable for high probability swings. It doesn't mean you can't take short-term trades. It just means that it's not highly favorable for swing trades. New Zealand dollar. Look at this pair here. If we look at this pair over the last 3 to 6 months, is this pair in a consolidation, reversal, or trending? It's in a state of trending. It's going higher. It's making higher highs. It's making higher lows. We have an intermediate term high formed here, but we have since resumed going higher. So my question is, would this be a pair that you could be favorably hunting swing trades? Absolutely, because it's not having a difficult time moving above old highs, okay, and it's staying one-sided. You can see that it's finding support. All down candles are finding support, and it's breaking through all the up candles that make short-term highs. Every time that's occurring, it's showing institutional order flow rather. It's giving you the bias that this pair wants to trade higher. It can't be argued that if you look at something like this versus the euro or New Zealand versus the Australian, or even New Zealand with the pound. Now think about what this does. Imagine the relationship between the British pound and the New Zealand dollar. What elements would you expect to see in price action if you combine this profile with that profile? What would you expect to see in price action? And how would that relate to swing trading? Would you expect moves that would be significant? Would you expect small ranges or a consolidation? These are all homework assignments. I want you to take a look at your study using these ideas. But I'm highlighting the importance of looking at the weekly chart first. And again, you're going to do this on the monthly chart. On the Canadian dollar, we're going to do the same thing. A little too aggressive there, Michael. Okay, now the Canadian dollar versus the dollar. Is this in a consolidation, trending, or reversal? It's in a consolidation as well. Could be reversal. Could be seeing some measure of reversal up in here. We don't know yet, but right now, overall, easiest one to reach for is consolidation. If you have to think about it, if you have to weigh out whether or not it's trending or not, then it's probably not. It's either jumps off the chart at you 3 to 6 months. Is it moving in a predefined range, or is it trending? If it's trending, then you know that this market is being accumulated or distributed. Okay, if it's moving higher, buyers are really buying it up. If it's moving lower, they're really distributing or selling it. So if we know that we have a consolidation in this pair, we have consolidation in euro, we have consolidation in Aussie, but we have trending environments with the pound, we have trending environments with the New Zealand, okay? So we already know that New Zealand and pound, those pairs, coupled with other pairs, should have nice swing trading models. But we're focusing primarily on the dollar, so what I'm saying here is swing trading for dollar-based currencies are best suited in New Zealand dollar and pound dollar right now, as indicated by the weekly chart. We're going to skip over yen. We're going to go to dollar Swiss first. And I shouldn't have to draw this on here, but I'm going to do it for completeness sake. You can see that we have the Swissy against the dollar. It has also maintained a distinct range. It's consolidating on the weekly chart. Now, I know some of you are probably looking at this thinking to yourself, well, okay, Michael, this is a weekly chart. And you could be a swing trader on a lower time frame. Well, that's not how I define a swing trade. For a swing trade, I need the weekly chart to support the idea, because then I have a great deal more magnitude expected. I don't have just a daily chart, for instance, suggesting it's going to go higher or lower. I have a weekly and a monthly chart. And if these time frames indicate that the market is really wanting to go higher, or that there should be support level, and therefore it should reach for a higher PDA that would be above the marketplace, like a bearish order block or an old high, that should draw a price up there, because I'm trading off of a monthly and weekly chart. But if I don't see the profile that is supportive of a swing trading idea in that pair, there may be a trade to set up that it comes to fruition and I just didn't see it, and I'm okay with that. But you're going to see, if you go through the charts like this, you can't miss the big moves. They just can't hide from you. It's impossible for it to hide from you, because you're limiting your scope to only the markets that are really being pushed around. And not every currency is going to move in concert in contrary direction to what the dollar does. It may stay in a consolidation while the dollar goes higher when it should be going lower, or vice versa. If the dollar's going lower, then the foreign currencies all should go higher. That's the general idea or theme, but it doesn't always occur. And the way you avoid getting caught up buying duds, okay, or selling markets that won't go lower, is you start here. You look in the marketplace on the higher time frames and see, are they in consolidation? Because if they're being held in consolidation, there's a reason. There's no interest in buying and selling it. Otherwise, large funds would be pouring into them. So we have another consolidation here on Swissy. And now we're going to go to the Japanese yen. Okay, in the last 3 to 6 months. Okay, has the yen versus the dollar, has this pair been in a consolidation, reversal, or is it in a trending environment? Clearly, it's been in a trending environment. So now think about what this does. We've highlighted the markets that have the largest degree of displacement. It's clearly discernible. We're looking at a weekly chart here, okay? And once you do this with a weekly chart, you can just quickly, easily toggle out to a monthly. I just like seeing it on a weekly chart first, and you can just see the same thing being displayed on a monthly. So we have displacement in here, okay? The idea is we have the market wanting to go out of a consolidation. Now, when we say, why am I saying 3 to 6 months? Because in the last 3 months, there's going to be consolidation. Why? What are we looking there? Why did I say 3 months? What's that? What's the significance behind 3 to 6 months? Well, 6 months away from today, that's about how far back I want to use for determining what the probable direction is going forward. When we use IPTA data ranges, we look back the last 60 trading days. Okay, that's basically incorporating the last 3 months, even though it's not 90 days. Okay, looking back in the last 60 days, you'll be able to see where the liquidity pools are and what IPTA data ranges would be most likely targeted. What liquidity pools, what voids need to be filled, what old highs need to be violated or retested, or old lows, all those ideas. What breakers above and below the marketplace, all these ideas, you're going to still use them on the monthly and weekly time frame. But when we look back for the last 3 months, okay, what that will help you do is it'll frame the not as high as probability that you would see if you look back to the last 6 months, like this is the range I'd like to see. But if we go back just 3 months, let's say it's like this, okay, that's still indicating a swing or trending model. But if you go back into the other pairs, like the Aussie, say we cut that in half here, it still shows us what? Consolidation. So by looking at the last 3 months, are we in consolidation? If it's left at 3 months consolidation, we may be on the move, and we have to watch it and see. If it breaks out above an old high, we don't want to see it trade back into the range. We want to see it keep on finding new buying. That will give us a swing trading setup. We'll wait for a scenario to transpire on a daily chart, and then we'll take action. If you look at the dollar yen, okay, if we go back, say this is looking back just 3 months, we have this range in here, okay? We drop down into a daily time frame. There's a couple swing trades in this pair. They're in this chart, okay? You have one, this order block, it trades down into it in here, closes in the range. There's a swing trade right there. Now, I know what you're thinking, but Michael, I want to buy down here. Well, there's other patterns and techniques that we use for that. But this model, for swing trading, we're looking for things that are already in alignment. We already have indications that the market wants to go higher. This pair is under a trending profile on a weekly chart. It's wanting to go higher. We already identified that the monthly and weekly has a bearish order block, which is up in here, which is what it reached for, okay? This buy in here is a swing trade because it retraces back down and it has yet to fulfill its higher time frame objective or trade to its monthly and weekly PDA. This is a swing trade. The duration is 2 weeks or longer. This is a daily chart. You can see that transpires here. You're not going to get a million swing trades, but you're going to get ones that give you really high probability setups and low risk. And you're going to get instant feedback. You're going to know right away where they're at, why there should be sensitivity at that level, what direction should you be focusing on. And in between all this, you'll do short-term trades. And when short-term trades are in between setups, you'll do day trades. Or you won't do day trades if you're not a day trader. But in between long-term position trades, you'll do swing trades, short-term trades, and day trades if you're okay. And for those that are action hounds, you'll scalp while all these things are going on. All of this stuff will mesh, but you have to take a step back and say, okay, how many times can you buy in here on a swing trading model? This is the classic scenario because you have an unfulfilled objective and there was nothing up here that would indicate willingness to go lower. The buy on the order block, go back on your notes for the um, institutional order flow. And you'll see that we should be finding support at every down candle. We see that. Was there buying? Yes. And it quickly moves away. Did it take out the up candles? It does here on this candle. Okay, well, what can I do? What can I do next? Well, you have all these 3 candles here. This is now all one bullish order block. Down, down, down. After this big move, they've taken out this order block's high. Okay, so it means you can be a buyer when it trades back down into this 3-bar formation. It's this one series of 3 down candles or bullish order block because smart money's buying in a down move. You split that range in half, that's your mean threshold. At the mean threshold and above to the high, that's where you're looking to buy. Anywhere in there, and here's your return back to it there. Now you're looking for institutional levels in that to frame an entry. So you can be a buyer here, or you can be a buyer here. That's it. There's no other swing trades. This pair has no other swing trade setups outside of those 2. There are short-term trades, there are day trades, but that's it. There's no other swing trades. Now, you're looking at this and thinking, but this is chasing price, Michael. This is buying near the highs. No, this is buying in the middle of an unfulfilled range. You got to look at the monthly chart. You got to understand that this monthly and weekly chart had reasons, as we disclosed in the mentorship, for to go up to those levels on the monthly and weekly chart for dollar yen. So while this would be looked as buying near the high, if you're just looking at a daily chart, yeah, it would be true. But the weekly chart had this range back here to close in, this last up candle, bearish order block. We had a void in here, fair value gap. All those were unfulfilled, and price needed to go higher. Once it closed in that range, here, the wick to the open, that's when you had some retracement of any measure. So when you see price in these higher time frame consolidations, that means there's somewhere a pair that is in a trending environment. And there's going to be times when the dollar's trending, all the other currencies are going to be trending, and maybe 1 or 2 will be in held consolidation. That in itself, as we'll talk about in lesson 3, will present opportunities. Remember, the market makers will hold pairs in consolidation and let other pairs rally to manipulate the majors. And by manipulating the majors, that's how they control the crosses, like euro pound, euro Japanese yen, pound yen, or these exotics like, well, I don't even know. I don't trade them so much. I couldn't think of the top of my head what they would be. But, well, Aussie yen. That's a pair I don't like to trade either, but I know there's a lot of people out there that like it. I just don't trade it. But nonetheless, in summary, the dollar index on the weekly chart. If we look at what we see here in the last 3 to 6 months for this pair, if you take a look at the last 3 to 6 months for this one, has the dollar index been in a consolidation or a trending environment? Trending environment. So if we see the market making higher highs and higher lows, we're in retracement here. It could be reversal, but we are looking at a trending environment nonetheless. It's not having a difficult time moving outside of its small consolidations and ranges. So it's made a willingness to go higher. Contrast that with the euro. It's in consolidation. Couple that with the dollar index. It's bullish on dollar. So we should be what? Can't really swing trade euro, but as a preview, this means that you can be a short-term trader on euro dollar, and you could be looking to do what with it? You could sell it because you have up movement in dollar index while the euro dollar is in consolidation. So it's underlying strength in the dollar, which would be weakness on the part of the euro dollar. So, and that's why you see, even though in this large consolidation, every big significant move has always been on the black candles. They've been down, and very little, and it takes a lot of time for this pair to trade higher. So in summary, I want you to think like this. This is some homework for you today, and it won't take you beyond today to do it. I want you to look at the relationship to the pairs that we've outlined that are in trending environments on the weekly chart. Couple that with the pairs or currencies that are in consolidation, and go through the last 3 to 6 months and share on the forum your observations about what setups, if at all, occurred on a swing trading basis. That means you can't drop down below a daily chart. Don't do anything less than a daily chart, because we haven't started talking about entry patterns or anything for 4 hour yet. But make some observations about what you see in relationship to this pattern or viewpoint, because this is what you want to look for. Okay, I'll just say it like this. As a fund trader, this is one of the filtering processes they do. They look for pairs that have a willingness to want to move. Okay, I don't need moving averages. Moving averages were a crutch for those in the free tutorial stuff, but all you're doing is you're looking for the evidence that the market is in a consolidation or that it's trending. If it's trending, it's obvious. If it's not obvious, it's consolidation. If it's in consolidation, anticipate reversal, but wait for the confirmation that it's already moved out. And because it's a long-term chart, we don't care that we're waiting for it to break out and give confirmation. If you go back to the yen, what we got here? Go back to the yen, go down to a daily chart. The newer trader, or the less experienced trader in our group that would be looking at this, saying, okay, well, if I bought here, that's really not that exciting because I want to buy here, okay, or I want to be buying down here. That's other setups, that's other scenarios, that's other conditions, okay? Swing trading is highest probable direction when the buying should be occurring. You're buying it. The drawdown is very little. Its timeliness is impactful. It means you get immediate feedback. If it's a strong swing trade and you have these conditions, you will not sit around waiting for profitability. It will move in your favor instantly because more money is going to be piled in behind that level than just you. You're not even on the radar screen. So if we see these conditions like this and you bought here, okay, if you bought anywhere in this area here, we'll just say we used about the middle point of that candle. That would be low. The close comes in at 111.67. Open is 112.66. So we'll just say 12. You went long at the 112 big figure. Okay, 112 big figure. Well, good grief. Over here at the high, you're already at 200 plus pips, 280 pips. I already told you that that's the scenario you're looking for. 200 to 500 pips. That's what these setups give you. You don't need a lot of them over the course of a year. Every pair is going to give you something. If you wait for it, it will be there. But it's not going to be every single time there's a setup basis to the dollar. There's going to be some give and take. And that's why you want to have to go through all the majors, okay, like this, and you're going to find setups. If you hold on to this thing for 2 weeks, this would be the day you'd be entering, or this day here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, thereabouts. It's 2 weeks. There's your high. Think about it, folks. This model is not an everyday situation. It's a high probability swing trading model. That means you're looking for the highest probable direction to trade where you know the institutional sponsorship will be behind your idea. And guess what? If it takes this order block out and you get stopped out, you get immediate feedback. That means you have to do what? You have to drop back to a weekly idea. Go back to a PDA on the weekly chart because the daily broke down. So where's the next level on the weekly chart to look for support? If that gives way, well, we'll probably reverse, and then we'll wait for a rally up, and then we'll sell into a bearish order block. You'll see that there's no reason to fear taking a loss. Everything will be systematic. It's methodical. But don't think that you have to have the lowest low and the highest high. In swing trading, you're getting the meat in between. That's all you're doing. You're getting that lion's portion of the flesh. And that's all you need. If you just did this a couple times a year, you'll be blowing away every expectation you ever had for trading because you're going to be able to do more with less. And that's what really trading is. You want to be doing very little risk, very little trading, but having huge profitability or probability in your favor. And this model is going to help you do that. So we're going to be using a lot of the things we talked about in the higher time frame macro analysis to frame the ideas using what we just disclosed here also, and it'll build very specific ideas about swing trading. And you'll know exactly when you should be swing trading. And if it's not there, don't worry about it. Don't push it. Don't force it. Just wait. Or when we start going into the short-term trading, then you'll know what you should be doing there, because you have a lot more trade setups with the short-term trading, because you have one every single week. Every single week. And then when we get into the day trading stuff, there is a trade every single trading day if you're a day trader. When you use the model that we teach, and it's always going to complement the things that we're teaching here, just like this is going to complement the teaching we have for macro analysis. Every discipline is subordinate to the one we just did in January. Swing trading is going to be subordinate to what we learned in January, and then short-term trading is going to be subordinate to what we teach here in swing trading. Because in between swings, there's smaller swings because price is fractal. So in between this buying opportunity and this high, we can only really see two favorable entries. This one and this one. Apart from that, there's no swing trading entries based on my rules. But there is two more short-term trading. And in day trading, you got every up candle in here as a potential buy. So you'll know how immediately, no matter what asset class, whether if it's a metal, if a commodity, a bond, if it's a currency, a stock, it does not matter. You'll immediately, in less than 10 minutes, using every time frame from monthly down to a 4-hour time frame, or if you're going to be a day trader, down to a 15-minute time frame, you'll know how to slice and dice that chart and be able to frame out whatever type of trader you want to be. And you'll know where the next move is going to be in relationship to that. Is it poised to move as a swing trade? If it's not, okay, no problem. Let me drop down to a short-term trade. If there's something there, I'll take it. If it's not, okay, where is it at in reference to day trading? And I say that because it's not to say that like the euro is in a consolidation, so therefore don't trade euro. No. I'm not saying that. I'm just saying in terms of a swing trade, you can't use that pair right now because it doesn't have the willingness to want to move yet. It will. And when it moves, it's going to move a lot because it's being held in consolidation. And when this thing blows out, whether higher or lower, man, we're going to have a lot of opportunities in this thing because they've been holding it for months. Look at what they did over here. It's been in consolidation and a move, huge move. We're going to see another one of that. Okay, it's just winding up. Just wait for it. Don't force it. Do not try to push yourself into a trade. Just because it can't give you a swing trade in the euro dollar doesn't mean you can't take short-term trades. Look at, I mean, we've been talking about the euro dollar going higher. It went higher. You could be a day trader in the euro dollar. Okay, so there's plenty of opportunities. There's always ways to make money. But I have to give you the mindset for each individual discipline of trading for that month and not show you other time frames because it will blur your learning. You don't want to be focusing on all that stuff. And you'll see as we go through, each one complements the next. And you'll have a complete view of how the marketplace works, what drives price, and how to find the opportunities. Just like that. It won't take but just a few minutes in any time frame. You'll know right away what you should be doing. But we start on a higher time frame to frame out where is the large flows. Because if there are going to be a lot of money pouring in behind a buying opportunity, you'll see it on the weekly. If it's not going to be there and it's going to be in consolidation, no problem. Go to the next pairs. And you can quickly see how the contrast between the New Zealand dollar and the yen, they were paramount across the board over the last 3 to 6 months because they were unwilling to stay in a range. They were pushed out. They were driven. And if they drive one direction over the other while other markets are being held in consolidation, that tells you where the money is. They're buying up Kiwi and they're buying up, they're selling yen and they're buying up Kiwi. And you can see it. Dollar yen rally, that means the Japanese yen's declining. And you can go into the futures chart and you have to see that too. But the point is, before we get into the $1 million swing trade setup, you have to have this understanding, knowing that a market that is poised to have movement behind it, this is how the fund started. This is their first filtering process. Is there a displacement that pushes the market one side over the other? If there is, it's evidence on the higher time frame. And if it's not, they won't go into that market. They're going to go into the ones that have a willingness to move. And look what happened in the yen. Look how many pips this thing has moved. I mean, we had a high, and this thing almost moved like 2,000 pips almost. 2,000 pips. That's a lot in relationship to that of, say, a Aussie dollar. A little wimpy old 600 pips. In euro, like 900 pips, something like that. On the downside, something like, close to that. And then you have the pound dollar, where it had thousands of pips. New Zealand, about 1,000 pips. So which pair are you going to trade as a swing trader? Are you going to be looking for pairs that are in consolidation, or ones that are making clear, discernible patterns higher in an uptrend and keep breaking old highs and supporting price at old down candles? That means you see institutional order flow. That means the funds are pouring money in. Every time they do this, more buying is going to take place. Reverse for the sell side. Every time that there was an up candle in the British pound, up in here, right before the down move, they returned back to it here on the spike up here, and then it rallied lower. Everything that we look for PDAs, you use on these time frames, but you start with filtering out whether the market is wanting to move in a trend or if it's in consolidation. Notice I didn't pull any trend lines up. I didn't pull up any kind of moving averages. I didn't put in any kind of indicators. All we're looking for is a simple profile, and it's simple. I can put my 9-year-old right in front of this chart and ask him which one's going sideways and which one's moving up or down, and he'll be able to do it. So think about it. If you ever struggle, if you have a small child, take them to your computer and say, okay, inside this box, would you say this is going up, down, or going sideways? And the answer they give you, that's it. It's just that simple. And just look at the pairs, study them, okay, and look at the relationships between other currencies that they're paired with, every available currency pair, and look at what's happened over the last 3 to 6 months in relationship to that. And again, I'm not trying to convince you or talk you into doing major crosses like pound yen or Aussie yen. I'm not trying to do that, but I just want you to see how, even though I don't, as your mentor, trade those pairs, you may like to do that. And there's many opportunities throughout the year that you'll be able to trade those. And I'll give you rules for it, but for me, I just don't get the tax treatment trading them. So it's not worth the extra step, because you got to do the analysis twice when you trade those pairs, which to me, it's not that big of a deal, but to me, I just like looking at a dollar index and then looking at the dollar crosses, and then it's done. I either know I have a trade or I don't have one. But as far as swing trading, this is it. This is your first stepping stone. This is what you do. You look for this, and this will frame out what pairs are really ideal for you to trade as a swing trade. If it doesn't fit this criteria, it's not a swing trade. It's just that simple. You got to go to a lower time frame discipline. That means short-term trade it, or day trade it, or scalp it. Plenty of scalps in euro. Plenty of day trades in euro. And there's a couple short-term trades in there. Not in swing trading. So I'm going to close it here. Wish you all a very pleasant afternoon. And again, I'm going to be looking for ESME or SQA. If you could please create a thread in our forum for this lesson today. Just title it as, what will we title it? Higher time frame swing model confirmation. We'll just do it like that, or something to that effect. And then you guys can post your observations there. I know some of you are just going to wait and see what everybody else does and then look and see what they did and then come to agreement or disagreement about it. But do the work, okay? Really, when we do these individual disciplines each month, for you to learn, I'm going to push you into a form of investigating it. I do not want you to take what I show in a PowerPoint slide or a video okay, and take that as the gospel. That's not how you're going to learn this. You're going to appreciate it more when you go in gradually. As I tell you, look for this and you'll see it. Look for this and you'll see it. And when you find it, before I start going into greater detail about it, when I do the teachings, it'll be like, oh yeah, this makes perfect sense. I see that. I know exactly what it's talking about now. And then once you have that, you graduate to a higher level of understanding and a greater appreciation for what you're spending your money on, not just your time. That way you'll know by the end of this month, you'll know exactly what you're looking for as a swing trader. It will be absolutely certain what you're doing, and you'll know when not to trade. That's the most important lesson. Don't force a swing trade if the conditions aren't there. Think about it. If you're a day trader, you know that if I'm a bullish person, I want to be buying at the open or below it. Well, why would I want to be selling it if I'm bullish? Think about it. It's the same thing. Don't force an opinion or a viewpoint or a discipline of trading in a condition that doesn't favor it. If the market's not predisposed to go in a trending environment, higher or lower, don't try to swing trade it. This is what beats traders up. Or they get into an idea and they take a swing trade and they get in there and they see initial feedback that looks positive, they have a little bit of profit, and they marry the idea. And they're on Facebook, they're on Forex Factory, they're on all the forums, they're on Twitter. I'm going to kill this one. And all of a sudden it reverses them, and then you don't hear about them. They go quiet because they got beat up. And it turned on them because it wasn't a favorable market condition. This is such an easy filter, but nobody does it. They don't think this way. But I'm telling you, as a large fund trader, this is the first thing they do. They look for a trending environment filter, or if it's in consolidation. If it's in consolidation, they cannot put money into this until it breaks out and moves, because that's their business. They have to be involved in a trending environment, because that's what 95% of all large fund models are. They're trending. So if they see this, they're not going to see this as an opportunity to pour money into it. They're going to put their money in where it's already moving, because it's already showing them willing to run, and they want to run with the bulls, or they want to run with the bears. They do not want to swim in a small little pond like this. It ain't going to move. There's no stream. There's no current. So you have to go where the large fund's going to go. And this is just a simple little procedure that no one looks in their charts for, but this is exactly what goes on. Then you'll be able to find where all the big money is being pushed in and where it's going to sleep. So with that, guys, I'm going to wish you good luck, good trading, and I will see you tomorrow. We're going to have another session at 9:30 a.m., and we're going to be doing the homework for the New Zealand presentation I did in lesson 1 for this month. So until then, folks, I will talk with you all today in the afternoon recap. I'll send the charts up and all that business. But again, tomorrow, 9:30 a.m. Eastern Standard Time, New York time, we'll have another session. If you haven't done your homework for the New Zealand portion, please try to do that. If not, don't watch this video until you do it, okay? Don't watch tomorrow's video until you do that homework. Until then, good luck, good trading.